so many LP documents are really set up so that in a pinch, the sponsor can take your money as an LP legally. And it was actually frightening because at the end of the day, you are ultimately trusting how is the sponsor, the general partner, going to handle your money when things get hard. I saw sponsors bleed the companies dry to the point where there was no capital to return because they were sucking fees out of the business.
The views expressed in this podcast are those of the individual guests and do not reflect the opinions or recommendations of Invest Clearly. This podcast is for informational purposes only and should not be considered investment advice. The appearance of a sponsor or investor on this show does not constitute an endorsement or a warning. Invest Clearly is an objective and neutral platform. Always do your own due diligence before making any investment decisions.
Nathan, thanks so much for joining.
Joe, good to be here. Appreciate the time.
Yeah, I'm really looking forward to this conversation. Obviously, been able to catch up a little bit ahead of time. But before we jump in, would you mind giving a little overview about you and ARX Capital for listeners that might not know anything about you?
Sure. So I am based outside Philadelphia, western suburbs of Philadelphia, and lived in Pennsylvania for a better part of 20 years, a little over 20 years, after growing up in North Carolina, and fell in love with real estate at an early age, and actually moved to Pennsylvania to be an assistant basketball coach at Lehigh back in 2002. And I did my master's degree, my MBA at the time, and realized about a year in that I didn't want to coach forever, and landed at a small home building company, privately owned home building company, in land acquisition. And that was where I really got to continue to develop my passion for real estate in the built environment. I had an opportunity to go into investment banking right out of college, and chose not to do that for a variety of reasons. But I think one of the core reasons was I really do enjoy the physical, real assets part of the economy. They tend to be, I think if you do it right, tend to be lower risk with return that's outsized for the risk that's being taken. We talk about that a lot in our business. Was able to move through that business, that home builder, become one of the three partners, and it eventually became one of the largest privately owned home builders in the country. 2015, I think we did 400 and something closings, about 120 million in sales, and then I split with my partners in 2016, and I started ARX Capital, which is hard to believe it's almost 10 years ago now. And I was fortunate that I had capital to invest, and I think this will be kind of as part of my story is getting started with capital is very different than getting started without capital. And maybe that feels like an obvious statement, but I think about it a lot because I look at people in the business, and I have friends who they strive. Either they don't have capital, and so they're finding ways to do deals without capital, which provides some creativity that sometimes I feel like maybe I don't have, because they're just, the deal doesn't happen unless they can figure out a way to patch it together. But I think the advantage of starting with capital is you don't have to be, you don't have to move faster than you should move. And so what I began to do was I started to pick some different businesses that I could invest in through ARX Capital that gravitated toward real estate. I did a residential land development deal. I did a historical rehab of a home. I invested in a manufactured housing fund. And as I started to get the feedback from those investments, I began to kind of refine what I wanted to spend my time on, and ultimately really landed with a focus on manufactured housing, specifically direct investing and managing those investments through ARX Capital.
So fairly hands-on in your investments.
Yes. And, that's part of my heritage here and my upbringing in the business is maybe to a fault is super hands-on. I could be accused of micromanaging. But, I have to go back to the Great Recession, which I think is relevant because we have so many people in the kind of syndicator space, the general partner space today, who don't know what it was like in the Great Recession. They've actually they were in college or they were in high school, and yet somehow they've raised hundreds of millions of dollars, and they kind of believe it's always up and to the right. And I was running a home building company in 2006, 7, 8, 9, 10 through 15. And where the only way to survive was to be on site every day and looking customers in the eye and telling them and proving to them, hey, we have the money. We're going to build your home. We're going to stand behind the warranty. We're going to be here to make sure the community is not one that's left with, spot lots, and you don't know who's taking care of the empty lot and the weeds that are growing up. So that we carry that through our entire business.
Yeah, that I can see how that would dramatically impact the way you approach investments. Also, just to pick up on one other thing you said, you kind of started with your own capital. I assume that impacts your approach as well.
It does, and I think I mentioned patience there. And I think you could be impatient. You could say, "Oh, I'm getting 0.2% of my savings account. I got to deploy this." But I didn't need to earn fees to kind of keep the lights on. And so I was able to really look at the universe of investing that I was contemplating, and think about how I wanted to develop kind of long-term returns for our family. And I did have, I had a thought. It was very clear. I'm sure I wrote it down somewhere. The process is going to be, I'm going to invest with others and refine what I want to do with my own time. Then I'm going to invest my own capital, and we'll prove that I can earn a good return on that. And then maybe we'll invite some other people to invest with us. And we followed that path that I set out back in 2016. And today we've got multiple manufactured housing funds. We have some land development investment opportunities, and we do some one-offs here and there. But the differentiator is my family and I are making the first and largest investment. So today we probably own about 50% of the total equity, across all the funds through our own cash investments. I'm not accounting for, promote returns and stuff like that. We're putting in, significant 7-figure checks to all of our investments.
Wow. So it sounds like for you, if I was to summarize that, like skin in the game, for lack of a better term, is kind of a big piece of your investment philosophy. Both not just in your cash, but in the more important resource, which is time.
Absolutely.
You're kind of got both of those. So it's interesting though, because you're heavily invested in these deals, and I think that there's that there would be a tendency, maybe with some, to be less responsive. I mean, the LPs are making up a smaller share of the deal. Like, you're working really hard in it. But one of the things I saw just, in your reviews, which again, they're on your website, we'll look forward to those coming to Invest Clearly,
Sure.
Is how responsive you are. So like, talk to me about how you feel, like what your commitment is to your LPs, like how you view them kind of in your ecosystem.
Well, they're absolutely critical for us as a group. And, I think we've made the conscious decision that we're not looking to blow that list up. It's been, frankly, it's been a lot of referrals, where the greatest, I think, compliment we can get, maybe it's a little cliche, but is your referral. And so our network has expanded more slowly, but, it's rarely 2 or 3 degrees removed from, somebody that we already know who is investing with us. And I saw just on a headline this morning, I think the president's going to sign an executive order to create more opportunity for private accounts, retirement accounts and stuff, to invest in private assets, private equity, and so on. And on one hand, I'm a big fan of that. I think it's a great opportunity for investors who've been left out of that. I do think one of the biggest drivers of success for LPs is having a personal connection with someone. There is in my opinion, while we should say that accountability should be the same regardless of whether you know someone, I would say that I feel personally, in my gut, a significant weight when I know I'm going to run into someone at the golf club or at church or at the coffee shop. And it's not someone who's kind of faceless, in some other part of the country. And so the challenge for a sponsor like us, who I think has done a phenomenal job for our limited partners, is we're not going to grow very quickly with that, modus operandi. It's going to be more slower growth. We're not just going to blow up and go from 1,000 lots to 10,000 lots overnight, because we're going to limit our capital because we're just not willing to go out and do calls with a bunch of people that are 4 degrees removed from our network.
Do you think that's in part? I mean, you mentioned earlier that obviously you guys are heavily invested in the deals. You're really talking about growing your own capital. So you don't really need to make money on fees. You're really, it seems like your orientation for yourself and for your LPs is more on like equity growth long term.
Yeah, it is. And I probably like you, Joe, I follow LinkedIn and the chatter, or like, is it IRR or is it return on,
Right.
total
Yeah,
equity multiple? And
that seems to be the
um,
question today.
I think, yeah, I will say one of the evolutions I've gone through that relates to this is when I was investing in other LPs predominantly, um, I'd read the subscription documents, I'd read the PPM, um, and I would say that I'm a fairly sophisticated person, and I could understand, I think conceptually, a number of the terms there. But not until I had to write my own documents and go to market with those did I really understand how so many LP documents are really set up so that in a pinch, the the sponsor can take your money as an LP legally.
Right.
And it was actually frightening, um, because at the end of the day, um, you are ultimately trusting how is the sponsor, the general partner, going to handle your money when things get hard. Because there are actually a lot of good reasons why the documents should ensure that they can pay themselves and keep the lights on to work through problems as they come up. But integrity, when rubber meets the road, is really, I think it's uncertain, what that person's going to do. And I've seen people lose money in a real estate market where, and frankly, no one should have lost money from 2016 to 2020. It's hard to fathom, how
Yeah.
people lost money, but they did. Um, and I saw sponsors bleed the companies dry to the point where there was no capital to return because they were sucking fees out of the business. And I just, you know, and I'll say, I won't name the partner, but I know somebody who had a bad investment. They were a general partner, lost a bunch of money to the LPs, and they gave all their fees back. Um, so I think, again, it's back to that personal connection and the integrity. How do you really know? You can't know from the documents. You cannot know how someone's going to handle your money.
Right. That makes sense. Um, and that's something that is obviously personal connections in general. I mean, I think in business and investing are kind of harder to come by these days, right? I think
Sure.
information is key. Introductions. Many LPs are, they're looking for deals. They want to deploy capital. They want to get access to the asset class, but they don't actually know anybody, right? And so they're starting from a point of low information. So let's talk. You said like when things get hard or go south or sideways. I can't remember exact terminology you used, but let's kind of like double click on that for a second. Obviously, this podcast is about trust and transparency with sponsors, and we've talked a lot about your alignment. But talk to me about how you think about communicating with LPs when timelines change or something changes in a deal such that the pro forma changes, the expectations need to be adjusted. Like walk me through that process for you. If you have a specific, if that's happened, and you have a specific example, it'd be great to walk through it.
Yeah, we've been fortunate to not have a lot of that happen, and that goes back to kind of our acquisition philosophy. But one of our core values as a business is, good news fast, bad news faster.
Okay.
And we follow that internally as a team. I don't want to be finding out that something went sideways at a property, slowly. Like I may be on vacation, but if we had a water line break and the news is showing up, like I want to know immediately. Don't go try to figure it out and then tell me, oh, we got it solved. No, like we're a team. Let's figure out how to solve this together. That communication is critical. And we have the same philosophy with our partners. It's fortunate that because we have that internal philosophy, as the largest partner, I get that information fast. And then, we share transparently. We've got regular quarterly reporting that we're providing to investors. And fortunately, we've been, I think, conservative in our underwriting, and we've been able to outperform that underwriting. One of the lessons from the home building business going back to 2002 to 2004 to 8 or so is basis wins, right? Like don't over leverage, don't spend too much on a property, because when things do go south, as they inevitably will, in terms of, I'm talking about macro economies and maybe local markets, housing demand, and so on, lower basis will protect you from the downside.
Right.
So that's driven our investing philosophy. I would say, like, to click into a specific example. I mean, we had a property in our first fund where it was probably a heavier lift. It proved to be a heavier lift than our initial underwriting evidence. And what we're constantly doing is looking at, right, what was the equity in that kind of mini business, that single purpose entity that owns this asset, and how much can we earn on that through the continued improvement of the property, whether that's capital improvements and rent raises and so on. And when we think that starts to flip against us, for instance, we're not keeping pace with the preferred return and then some, then we evaluate an exit strategy. And I think the honest assessment on this particular asset is we probably bought it with too much of an eye toward the tax benefits. And so while mobile home park investing is phenomenal from a tax benefit perspective, and it just got really good again because of the big, beautiful bill,
Right.
at the end of the day, the taxes should not drive the decision. They can be an important factor in the decision, but they should not lead the decision, in my opinion. I think there are a lot of people who bought bad deals because they could take a big loss, and they didn't know. Well, I'm going to get recapture on that depreciation I took when I sell this property at a loss. And we were able to work through that. We chose to exit the property at effectively our basis and move on and deploy the capital. We sent the capital back to the investors and moved on to focus on assets where we thought we could earn the return that they're expecting to earn.
And that was in a fund.
That was in a fund, yeah.
So that was just one deal in a fund.
Yeah, and I think it's worth clicking on that just because there are a lot of investors who say, just give me that single deal, right? I don't want a fund. But as an investor, I like the diversification. In this case, we're still outperforming our targets, and we'll continue to do that. We had one sideways deal. Everything else is outperforming. If somebody was just in that one deal, that would not have been good.
Right.
But I think what you guys are doing with Invest Clearly may give sponsors a greater opportunity to raise funds because the big question is, do I trust the person?
Yeah, I know that this is one of the things that's been interesting over the past 3 years. If you look at the broader market, a lot of syndicators did switch to funds, mostly because, or at least my assessment is because the deals weren't that good. So they wanted to still be able to raise money, but there weren't that many deals. But there's also just the practicality of it. Like raising money in syndications, you have to do it really, really fast. So
yes,
you either have an existing base of investors, or you have to be able to somehow acquire them and, quickly. And sometimes the costs aren't advantageous and so on and so forth. I think that funds are harder to raise for because they are by definition more sophisticated. It's easier for an LP to look at a specific deal and say, okay, yeah, I'm investing in that multifamily, or I'm investing in that hotel, or, that piece of dirt. And so hopefully you're right. I think insofar as we can help bring confidence to the actual sponsor, to the LP about the sponsor, it will make it easier to raise dollars into a fund, because I do think that is the diversification is helpful there.
It's the blank check hesitancy for investors, right? Okay, I see you've got a deal or two that might go into this fund, but how much more are you willing to spend on that? Yeah.
Without a doubt.
This episode of the Invest Clearly podcast is brought to you by Scale IR. If you're raising capital, the hardest part isn't just generating leads, it's turning those leads into committed investors. That's where Scale IR comes in. Scale IR transforms your investor engagement process with their proven solutions that optimize lead qualification, accelerate investor conversations, and drive higher conversions. From seamless CRM integration and intelligent workflows to expert investor qualification specialists who handle your initial discovery calls, Scale IR gives your team freedom to focus on closing deals. If you're ready to scale your investor relations and capital raising effectiveness, visit scaleir.com to learn more and book your strategy call today. Scale IR. Engage smarter, convert faster.
Okay. So do you think, obviously you did some LP, you were investing as an LP, owning a business, then investing as an LP, then starting your own firm. I guess, are there any examples of this, without naming names, but were there examples of where you were communicated with as an LP in a way that informed the way you communicate now as a GP?
Yeah, that's a good question. I could think of a couple examples. One specifically, I was investing as an LP in a fund. It was a partnership, and all of a sudden there became a conflict with the partners, and one was pitting themselves against the other, and I'm taking no position on whether the argument between the partners was right or wrong, but the individual partners started to communicate with the investors, their sides of the story separately. And you're going oh my gosh, this is not good. And how do I get out of this? Now, to the credit of the partnership, I just said, hey guys, send me my money back. And they did, which I don't, they didn't technically have to do that. But they did. And I went like, well, number one, partnerships are a big deal, right? Like to state the obvious. And so making sure those relationships are aligned is critical. And alignment is both incentives, but first, before incentives, to me, it's all values.
Right.
Do we value the same things in life? Are we trying to achieve the same things? What does integrity and character look like? So for us, I mean, we have traditional quarterly reporting, and I think, one of the things that's challenging with that is you want it to be useful. One of the things that drives me crazy, I was watching CNBC this morning and they were reading the Goldman Sachs numbers, and then Rick Santelli was going through this PPI data, and I'm just like, stop giving me data. Like, tell me what it means. And so for our reporting, I think we have good data out there, but the most important thing we try to do in our reporting is tell you what it means. Sometimes I think sponsors think either more information is better, or they're actually hiding the story by dumping information. Yeah, that's my sense.
It's so interesting. You're like the third or fourth person to say that, and I totally agree. Just having to like contextualize data for most of my career, it's the analysis of the data. That's what they're paying you for, right? Is ultimately the story behind the numbers, not just the numbers. And you're the third or fourth person to come on this show and say, hey, like a big data dump, great. Like, oh, you give all of the information. That's not that helpful. Like to your point, like even reading the PPM for an LP, sometimes not that helpful because of the way they're constructed.
Well, to your point, Joe, I saw somebody bragging on LinkedIn, yesterday that they give their investors their full, underwriting model. I'm like, well, I mean, maybe that's really transparent and great, but like I think they know inherently that very few people are going to look at it or understand it, and they're going to get a big check mark for being transparent. Like, okay, maybe that's okay. I don't know, but I really want to know as an investor why you're telling me what you're telling me. Like, tell me what it really means.
Yeah, right. What am I supposed to take out of this information? Again, I spent most of my career, or a chunk of my career, in corporate, and I think like that gets kind of worked out of you pretty quickly. You don't just show some numbers. Like the story is everything. Data storytelling is everything. So obviously we're in a moment in the cycle right now where LPs are a little shaken up, right? At least it appears that way. Kind of more capital sitting on the sidelines, like a lot of GPs getting questions about how the assets are performing relative to the market, so on and so forth. All right. Are you getting those questions?
Frankly, we're not. And I think it's because we tend to be pretty contrarian. So we were investing going into COVID and maybe early into 20, like we did a couple deals early 21. And then we just saw in our space in manufactured housing, we couldn't make any numbers work, but yet deals were trading, and we didn't understand it. And when I have that experience as an investor, we pulled back. And so we were able to do one-off here or there, but it was really hard to make sense of what was trading. So now that the people who were buying then have kind of, frankly, they've been bitten, they're pulled back, they overspent on some stuff. We're seeing more opportunities now. And I think because of how we handled ourselves, our limited partners are saying, hey, like, do you see anything? What's out there? And they know we're never going to throw a deal at them for an acquisition fee. Like, we're only going to bring them a deal if it makes sense. So like our first fund, we're 4 years into the first fund. That was about a $20 million equity raise, 21 million bucks. We've returned all that capital. We started to pay down the pref, and we still own 10 properties in that fund. Our second fund was about the same raise, maybe a touch less. And, I hesitate to say too much out there, but it's going to be better performing than the first fund. And that's kind of like in the books, if you will. So we feel really good about the opportunities today, and we've got a strong base of limited partners who are just, I think they appreciate our approach. They appreciate, the alignment that they have with me as both the general partner and the largest LP, that we're going to do what's best for them. Even if it means that, as a firm, we have to be lean in order to make it through the next deal cycle.
Yeah, that makes sense. Also very confidence building when money comes back and they're still just coming back. Right. So as you expand, is it is it mostly going to be manufactured housing? Are you open to opportunistic stuff? And like, what's the most like important thing about your relationship with investors kind of going into the future here?
I think the most important thing is staying up to date on the story, because I think that our story as a firm, I never intended it to be just manufactured housing. As I started, I talked about it, we invested in a number of different things, and I personally invest in a number of different things. While manufactured housing has been the core investment, what we really are about is finding unappreciated opportunities in assets, but specifically real estate assets. I think that's our focus. That maybe there's something that's tangential to that we would pursue and we'd offer to investors. But we really like the information asymmetry in real estate. I think that one of the reasons I haven't been a big fan of the public markets is there's so much information out there that,
Right.
I think you're competing with people who are analyzing, I say the playing field is fair and more level in the public markets than in the private markets, and specifically in real estate. So we're able to get information on properties. I've got a long background in zoning and land development approvals, where the real value that's created in the process, say, of entitling property, is outsized compared to what happens once you start developing it. So we've been able to bring some opportunities for land development to our investors. We think manufactured housing is great. We'd love to build manufactured housing. But unfortunately, most of the country doesn't want to see more of that. We see more opportunity in the long-term RV space. I think you mentioned opportunistic. I think that's a fair description of how we approach the investing universe.
Got it.
Is opportunistic.
Cool. All right. Well, we'll wrap up here, but before we do, there's one question we ask everybody, and that's, is there an element or what part of passive investing needs to die? So, when you think about the ecosystem, like what element of this ecosystem, or you could do elements, some people have cheated and given me to, is no longer useful and needs to be done away with?
So this is for the
Passive
what part of
investing conceptually, like,
yeah. My first reaction went to like all the the sponsors touting these silly things on their Instagram videos. Was what I say. I would like to see that die. That's not really a structural thing. I think that's a human thing. I would fall in the camp that the accredited investor criteria needs to shift significantly. I think we're keeping too many people who don't meet that criteria out of really good opportunities to grow wealth.
it's chipped down.
Yes. I think, there's some talk from this administration about passing a test.
Yeah.
How many, is wealth a sign of intelligence? And I'm not sure that fully correlates.
Yeah.
So I think, we've taken, and I'm in the manufactured housing business where, I think frankly, many of our customers are from a part of the economy in our society that is underappreciated and undervalued. And at the same level, I think we've decided that unless you have a certain amount of investable wealth or net worth, you don't have access to these better opportunities that I think, frankly, are better than the public markets. So I'd be in favor of opening that up by virtue of some kind of quantitative assessment.
Interesting. Okay, that's a new one for us, but we'll put it in the books. Okay, so thank you so much for your time. Before we finally wrap, please, if our listeners want to find you, they want to learn more about ARX Capital, where can they go?
They can go to discoverarxcapital.com and please reach out that way. We'd love to hear from you. You can reach me at nathan@arxventures.com. And we'd love to hear from you if you're interested in knowing more about our business.
Yeah, and that's ARX for anybody
That's
who's
right.
trying to spell it. So,
And go to Invest Clearly. You can find us there.
right. Definitely go to Invest Clearly. Yes, 100%. So yeah, thank you so much for your time. This has been great, and sure we'll talk soon.
Joe, thank you. I appreciate all you're doing.
All right.
Thanks for listening to the Invest Clearly podcast. To find verified investor reviews or to claim your GP profile, please visit investclearly.com. If you enjoyed this episode, please remember to like, subscribe, and leave a review, because that's how other people find the show. Till next time, invest clearly.